So our final speaker for this morning's program is Andrew Headley, who is a fund manager and head of global at Veritas Asset Management. Andy's the manager of the Nedgroup Investments Global Equity Fund, which is a concentrated portfolio that invests in high-quality companies from around the world. They invest with an absolute return mindset, a strict valuation discipline, and very much focused on capital preservation, which is actually very appropriate as he will be talking to us this morning about Mr. Market.
Okay, great. So I just wanted to run through the portfolio as we stand and what we're thinking going forwards in 20 minutes. So this is performance over 12 months, 3 years, 5 years. I'll run through the last 12 months performance, which is disappointing for us, really. Good in absolute return terms, but not very good in relative returns. It's disappointing partly because we were outperforming the market for pretty much the whole of 2020 until the last sort of 6 weeks, when there was a huge rally in a variety of things that we didn't hold, and so underperformed in those last 6 weeks. I don't think it's anything to worry about, but it is a little disappointing. The start of 2021 looks pretty reasonable, and perhaps we'll claw some of that back. Obviously, it's a very short period, but in terms of just breaking down the 12-month performance, as you just heard from Jeremy, the first quarter of 2020 saw the virus and substantial market declines. Because of the nature of what we do, which is we aim to preserve capital and invest in a way that is quite risk averse. We performed very well during those declines. I think we were somewhere between 500 and 600 basis points ahead of the market, so 5 to 6% ahead of the market at the end of Q1. The remainder of the year, though, with policymakers reducing interest rates and pumping a huge amount of liquidity into markets, led to what can only be described as a massive rally from the bottom, with markets up somewhere kind of 40-45%. Or more in some cases, Nasdaq certainly, from those lows in March, and we underperformed in that rapid rise. And when we look at the reason for the underperformance, which is shown on this slide here, we can see where we did well. So we did well in things that are kind of seen as tech. Most are in communication services as a sector. So Alphabet, Google, up 31% for the year. Facebook up 35% for the year. Charter, which is a cable operator and has been a long-standing holding for us, up 37%. So they did very well for us and big positions. Our underweight in low-quality areas, which is typical for us, financials, energy, real estate, also helped. But in terms of what hurt us, it really came down to two things. One was that we hold very little in IT. We had, on average, about 3% of the portfolio in technology in 2020, and technology as a whole. So the Nasdaq was up something like 44% for the year. So obviously that was very painful not having that weighted technology, which I'll come back to why we're generally underweight technology. And then the second thing that hit us was that within industrials, we have quite a lot of aerospace exposure. We think these are very high quality companies over time. Aerospace, so we've got Airbus, we have Safran, BAE, all of which we think are high quality companies, and we will see a very strong recovery in these over time. So they were the main positives and negatives in terms of detractors and contributors for the 12-month period. We were actually quite active during the year, so we came into 2020 with quite a lot of cash. We felt valuations were broadly high, and so we didn't have many opportunities to deploy cash, so we had a reasonable amount of cash. We invested all of that in the first quarter. So in the first quarter, we got to fully invested. And a lot of the companies on the left-hand side there under new purchases we bought during the first quarter in those major declines. So MasterCard would be a good example. Abbott Laboratories, Becton Dickinson, Cochlear, were all bought during the major declines. So we felt we were doing the right things and deploying capital at cheap valuations. In terms of the sales, many of those were made to fund purchases of companies that were much more attractively valued and higher quality. And so we felt we were increasing the quality of the portfolio at the same time as improving the rate of return that we thought we could achieve on the portfolio. So both things to try and achieve. So we made 6 sales during the year, which again is slightly more than average. We typically make 5 sales and around 5 purchases per year. So we've been a little bit more active than normal during the year. In terms of the portfolio and where we stand at the moment, this is a breakdown at the end of the year. There's not too much I want to bring out of these because most of the holdings that you can see on the left-hand side there are the same as we have held for a long time. Alphabet number 1, Charter number 2. Safran and Airbus we added to during the year. So obviously aerospace companies were hit very hard during the initial declines. We added to those positions in August and September, where we felt more comfortable that a vaccine would be developed, and over time, certainly in our investment horizon of 5 years, we felt that the skies would reopen and people's propensity to travel remains. We think that people will want to go on holiday, perhaps even more so. And 80% of travel, air travel, is leisure. Only 20% is business, which is obviously could be affected by working from home increasing. So we felt they were well placed. The share prices hadn't really recovered, and so we took a bigger position in Safran and Airbus. New positions for us in the top 10 are Fiserv. It's a new position during 2020, and Vanshi, and Intercontinental was exchange was increased during the year. Cash, as you can see, is quite low. We got fully invested during March. Cash went right down to 1%. And has slowly increased as we've sold a few things as valuations have increased. And then in terms of sectoral allocation, we're very strong in healthcare. We continue to be big holders of healthcare companies. They're very heterogeneous, our exposure, but we do think that they are exposed to a lot of very strong themes. Healthcare was not a great performer during 2020 as a whole. It obviously performed very well as a defensive position during the declines, but then didn't really participate in the recovery. We think over a sensible time horizon that many of the companies we hold are extremely well placed. And with the change in administration in the US yesterday, we think some of these companies should do very well because there will be an increased move to what's called value-based healthcare. So we think we're well placed within healthcare. As you can see, IT is now 10%. It's increased during the year, and that's actually the increase has come about through fintech. So MasterCard, which we bought during the declines, and Fiserv are both considered technology companies. Just putting the positioning in a slightly different way to try and help people understand how we're positioned within the portfolio. Obviously, we're fairly concentrated, so we have around 28 holdings, and we can categorize them into a number of buckets. So aerospace, I've already touched on. We obviously have big data, Alphabet, Facebook, Microsoft, all three of which we think are attractively valued, and we'll come back to where we think there might be some bubbles arising within tech. Consumer staples, financial services, as you can see, which we've increased during the year with Fiserv and MasterCard. Infrastructure, which we continue to like. We think this is a wonderful long-term holding for us. We can see good double-digit IRRs over very long periods in these infrastructure names. And then, as I've already touched on, value-based healthcare with quite a wide exposure. And we think over the next 5 years, the Democrats will increasingly push value-based healthcare as a way to reduce costs within the US healthcare system and improve the treatment of people within the US. So just a bit of a reminder before I go on to the current positioning of what we're trying to achieve. So as you know, we invest in only in high quality companies. So those companies that we see as having enduring and competitive advantages. We have a very long-term horizon. So we're looking at 5 to 10 years out in our investment horizon, which means that we hold companies typically for 5 years. So we don't chop and change frequently. We try and invest and support management teams and then benefit from the compounding of those companies. To do that, we do lots of fundamental analysis. So we spend a lot of time on each of our investments. We spend time with the company. We spend time with the competitors, with the peers, supply chain, and we build up what we think is a great picture of these companies. And then we try and buy them when we think we're going to get good absolute returns. So we are focused on delivering absolute returns. And we think that if we do this over 5-year horizons, typically looking to deliver kind of CPI plus around 8, then we think we will beat markets over the long term. And that's certainly been the case. Over the last 5 years, we've been in a bull market. So markets, certainly in US dollar terms, have risen at more than CPI plus 8. So in these kind of more bullish markets, it's generally, we think if we can keep up with these markets, we're doing okay. Typically, our outperformance comes when markets get more difficult and we see some declines or slow growth. So basically, as the strapline says, we're looking to invest in great businesses with attractive absolute returns. So just a summary of what we will do and what we won't do, which I think is important. In terms of what we do, as I've said, we only invest in companies with high barriers to entry. That means that we tend to be limited to certain sectors, healthcare, aerospace, IT, etc. We will only invest in companies that have sustainably delivered and continue to generate high returns. We are not going to invest in companies that are not returning anything, have no return on capital at the moment, but people think in 5 or 10 years that they will. So the likes of DoorDash, Airbnb, QuantumScape, these companies that have no revenue or very low revenue, and people think they will become a platform in 5 or 10 years' time, and so are prepared to pay extremely high prices for them. We will not do that. We have long holding periods, and we're absolute return focused in terms of valuation. So that means what we don't do, which I think is also important to understand, we will not invest in companies that we think have no competitive advantage, so commodity type businesses. We won't invest with companies with low returns or no returns. It's just not what we will do. We won't invest in anything we see as a fad or a fashion, so no momentum type investing, and I would say hydrogen and electric vehicles are certainly in that today. And we won't invest in companies that are concept stocks, pre-revenue, no earnings, no free cash flow. Understandably, people can make a lot of money out of those if you invest in the right ones, but on balance, the chances are that most of these companies will not generate great returns. And then I just thought I'd touch on the current environment and what we're seeing and how we're overall positioned. So in terms of what we're seeing from a macroeconomic point of view, it's clear that all the major economies are running huge budget deficits. No surprise with COVID, but now we've got the Democrats in power across all 3 seats of power in the US. We're going to see more government spending. Last year, the government in the US ran a greater than $3 trillion budget deficit, which is over 15% of GDP. They're managing to finance this, of course, by the Fed basically printing money. So it's not being sterilized. So at the moment, you're basically monetizing the deficit. So this is modern monetary theory come true. Short and long-term interest rates are obviously being held very low through asset purchases at the long end by the Federal Reserve. So we're in this period with huge deficits, very, very low interest rates, and a huge amount of liquidity sloshing around. Now, in the economic world, interest rates power everything. So obviously, everything in a way is relative. Even though we try and value companies on an absolute basis, everything is relative to what you can achieve elsewhere, so your opportunity cost. And so these low rates drive all asset values higher. And so we are now at a position where we've got such low interest rates around the world on the 10-year and the 30-year that equity valuations in some instances are certainly relying on these rates staying very low. And the question that we would have is, can this be sustained over a sort of 5 to 10-year horizon? And the issues, and we don't know the answers to these, but the issues we need to be aware of are the threat of inflation and the threat that government debt levels get so high that eventually bond vigilantes come back and we see some impact, which would obviously lead to higher interest rates over time. So having touched on the fact that we have these ultra-low suppressed interest rates and huge liquidity, what are we seeing? Well, we are starting to see, and this certainly came about during the latter half of 2020, highly speculative behavior in certain pockets. So we're seeing a huge amount of IPOs, record number of IPOs in the US. The quality of those IPOs is declining. So we're seeing a lot of companies coming with no or very low revenue, huge losses coming to market. We're also seeing the return of what are called SPACs, special purpose acquisition companies, which is a quick way to IPO and is generally associated with lower quality IPOs. We're seeing fraud. I don't know if everybody saw the Nikola material where they alluded to the fact they had a battery-driven vehicle truck, but actually it was just rolling downhill in the video. We're seeing amazingly multi-billion pre-revenue companies. So there's a very good example of a company called QuantumScape, which is developing a solid-state battery that might be used in electric vehicles over time. They haven't developed it yet. They spend $300 to $400 million a year on R&D. They have no revenue. Their share price promptly, I think, quadrupled to give them a $40 billion market cap at one point, which is pretty incredible. And cryptocurrency with Bitcoin, I don't really have a view on cryptocurrency, but clearly the rapid rise is quite speculative. We're seeing high equity valuations, so pretty much all measures, and I'll run through a couple shortly. We're seeing massive retail investor participation, which usually is a sign of speculation. So we're seeing pockets where the retail investors, so kind of the Robin Hood investors as they're known, who are trading on zero commissions, are investing particularly in things like hydrogen, so hydrogen assets and electric vehicles, which largely explains things like Tesla. And so with these companies that are exposed to these themes, it's seen as though no price is too high. So we're seeing these massive market caps for companies with very, very limited earnings in the hopes that they will grow into their valuations. And so we definitely see this market as one where we're beginning to see fear replaced by greed. Obviously, we saw fear in March. It's been a very quick turnaround. And this is evidenced by things like the put-call ratio. So there's a wonderful quote by Warren Buffett on the bottom of here. The key to investing is not assessing how much an industry is going to affect society or how much it will grow, but rather determining the competitive advantage of any company and, above all, the durability of that advantage. So I just thought I'd run through a few charts very quickly, more for people's interest. Bitcoin on the left. Again, as I say, I have no view on valuation of Bitcoin, but quite speculative in terms of the rise and doesn't imply it's a great store of value if it's as volatile as that. Cyclically adjusted PE ratio, 33.7, latest reading. Not quite as high as 2000, and obviously interest rates much lower, so some explanation for that, but still high. Price to sales ratio in the US, all-time highs. Again, some rationale behind that, given that interest rates are very low and we're moving to a more intangible type economy, but still it's quite an extreme move. Tesla share price up eightfold. I think it's around an $800 to $900 billion market cap today. So up eightfold during 2020. This one on the left is a company called Plug Power. It's been around for quite a long time, actually, but it's in the hydrogen world. It's trying to it sells hydrogen, which is where all of its revenue comes from. But it's also trying to develop hydrogen fuel cells, and so it's obviously gone up hugely as a consequence of this. And then on the right here, we've got the CBOE put-call ratio, which basically is an indication of sentiment. You know, when people are buying calls, they're positive, and when they're buying puts, they're negative. And at the moment, very few people are buying puts, and people are buying calls. So it's a good indication of sentiment being very high. And with that, I think I'm about 20 minutes. So, Anil, I don't know if you have any questions.
Thanks, Andy. That was actually very comprehensive. You actually answered all my questions along the way, so perfect. Thank you. Thank you very much to our valued investors for dialing in this morning. We hope that we succeeded in making the program very, very worth your while. Many thanks to our best of breed managers for their assistance in helping us to coordinate this event. And of course, as you know, there's certainly a lot of blood, sweat, and tears that actually happens in the background for these things. So a huge thank you as well to our production team, who was absolutely remarkable in terms of their assistance and getting the show on the virtual road. A reminder that registration is open for our Responsible Investing Summit next Tuesday. That's the 26th of January at 10 o'clock in the morning. We've got a great lineup of speakers like Clem Santa, Mark Morbius, and many more. So please do speak to your relationship manager for additional information on that. Until next time, best wishes to you and your loved ones. Please stay safe during these uncertain times. And thank you from all of us here at Nedgroup Investments.